Welcome to the Data Room, where we demystify go-to-market data for financially strategic executives. We'll explore case studies and deliver real-world guidance for finance and go-to-market teams to transform their data into a strategic asset. I'm Scott Stouffer, CEO of Scale Matters. Today's guest is growth equity investor at Edison Partners, Kelly Ford. Kelly, welcome to the Data Room.
Thanks for having me.
My pleasure. So as you know, Scale Matters is all about helping PE and growth stage VC portcos improve the use of their go-to-market data to basically drive better outcomes. I've recently heard that one of your portcos had kind of an eye-opening discovery around their whole new logo acquisition engine. Can you tell us a little bit about that and how that all went down?
Sure. I'll allow them to remain anonymous, protect the innocent. One of our top performing companies, frankly, in the portfolio, that were, they were blowing out their bookings in 2024. But the composition was more or less flipped from what they had in their budget, what they had forecasted. So they were expecting 75% of their 15 million new bookings target to be from new logo and 25% to be from existing customers. And we're at the mid-year point and only 20% was coming from new logo. And it was not obvious why this was the case, though one thing that was obvious at that time was that the sales comp plans were flawed. But there was a lot more to it than that. And we at the board level, started asking a lot of questions that couldn't necessarily be answered in our monthly update calls or in our Q2 board meetings. So the team went away and performed a forensic exercise that, as you can imagine, because the answers weren't readily available to them in their data, it took weeks. A lot of weeks, more weeks than I think I had anticipated. But ultimately, the data revealed a bunch of things. First being like, wow, our hygiene's not great, which was obvious. And I appreciated that the team started back on strategy. Their segmentation of their accounts from not only prospect, but once they became a customer, first of all, it wasn't lined up. They were segmenting customers based on what the customer was paying them at that point in time, right? Not what the potential value was of that customer. So how well do you really understand your prospects and your customers? That was a big miss, and something they've since resolved. I'd say related to segments, low value segments were not being prioritized due to low value assumptions and often, willingness to pay in that regard. So the whole segmentation exercise, once they learned that they just weren't classifying this appropriately, and what happens after you land a logo, how quickly this company was expanding the logos was proof. But it was as if they were looking over here at new logo and prospect data, and they were looking over here at customer data, and they weren't bringing it together on how the journey worked. So that was a big aha. I'd say also the new logo reps, because they have hunters and farmer model, and the new logo reps were holding onto their accounts and growing them for 12 months from signing. And it was a huge distraction from new logo signings, because it's always easier to grow your existing than go get the new. Another learning was part of our investment thesis was to move up market. And this company had a long tail in their business that was legacy. And so they found themselves moving up, but not all the way up on deals over the prior couple of years. So at some point they said, listen, there's a, 25K, it was a 25K floor. The floor is now 50K. We're not selling deals below 50K. And as it turns out, that was creating an obstacle to signing new logos. And what they learned further, it turned out to be a positive thing because they were able to undo that movement of the floor, was that they had very good success historically selling a 30K deal and growing it to 100K inside 12 months. So that goes to the reps staying with the account and growing them, which was it was by design.
Yeah.
But it also goes to segmentation because we said, "Oh, wait, no more of those 25, 30K deals. We got to do the 50 ones." But they weren't paying attention to what happened to them after they landed them.
And why was that, do you think? It almost but you said the reps were keeping them for the first year, but because I would see that scenario unfolding in a traditional organization where it had gone over to account management or client success, and because of the lack of alignment we see everywhere, that they had no idea that these relatively small customers, when you first got them, actually became quite lucrative within a year. Why was it at this company that you think they didn't have a finger on the pulse of that?
I think they were looking at it in isolation, like new logo funnel, new logo, not even quota because the reps just had quota. Like it wasn't
Oh,
new logo versus booking expansion. Um, and the expansions were selling like hotcakes. So there was no focus on it. We didn't have to shine the bright light in the dark corner. It was just happening. But then when you started to really look at it and they looked at historical like prior years, 67% of prior year new logos were signed less than 50K initial deal size. And the majority have grown by multiples since the signing.
yeah.
And the majority of 2024's expansion bookings were deals signed in 23.
Yeah, that makes sense.
But nobody was just giving it attention in that way. It was, "Oh, we have a new logo problem, let's focus over here." Well, wait a minute, what's going on? And then, "Oh, we're killing it on expansion bookings, why is that happening?" Hey, guys, guess what? It's connected.
Yeah, it's tightly
Yeah.
related. Um, Organizationally, because I'm trying to think of
How do you get here?
who would have proactively looked at this, right? You're talking about what we all commonly see, which is we see something that's not right and we say, "Why is that?" And then they have to go back through this painful exercise for a few weeks of trying to amass the data. Um, was there an FP&A group, or was there like any analysts on a RevOps function, or who do you think should have been looking at this kind of on a consistent basis, I guess, is number one?
So, there's an FP&A group, that's very good. This business is very data intensive just because of his business model, but they weren't in it the way you'd expect RevOps to be in it. Um, and I think the RevOps function was just immature. We didn't have a CRO at the time, but we had a VP of sales who wasn't, a maniac about data and process. So
Okay.
he's very capable, very good people manager, uh, has been blowing out bookings targets, generally over multiple years in this business. But there wasn't a how's the number going to be made and with a lot of rigor. But somehow, they have been successful in spite of themselves. And I'd say also the Salesforce implementation, it was constructed and fixed over time, but it was never kind of a wholesale, data model refresh and um, focused on the metrics that matter to make sure they know how to make the number, to make sure they're breaking down into pieces to know why things that are happening are happening. Um, so it was just kind of one of those age old, you know, grass is growing over that cinder block in the back corner of your yard and you forget about it and we're not going to go touch that.
Right.
But we'll go keep adding fields and process over here. I think it was that.
Yeah.
And it's still not perfect, but I think because of these exercises and the encouragement, certainly at the board level and as new executives joined, to sort of break these things down into smaller pieces and truly make them, repeatable processes and a cadence and standard set of reporting, and all of that has just been optimized over time, and certainly since this new logo challenge.
Yeah, interesting. And, back on the segmentation where they were basically segmenting based on how much people were paying them, and they had to get more sophisticated with that. Curious, like, did you guys apply your value creation team to help them do that, or did they have people internally that already sort of knew, what to do?
This was something they put in place very soon after we invested in November of 21. Um, we had strong, I had strong opinions about that and was very vocal about it ever since. And each year we said, okay, this is the year we're going to segment based on value. We need to understand our prospects and our customers better. We're not doing the value potential not based on the value that they're paying. We just don't know enough about these accounts if that's what we're accepting as our segmentation. And they went ahead and segmented the customer base in response to that, and we helped them in a bunch of different ways, but they never took it all the way through to prospects, which is where it starts, frankly, right? Because their point was, well, we know so much more about them once they're in the family, and we don't know as much about them when, okay, but we still need to go find out what we need to know about them. And we know the characteristics of this customer. We should be able to look at this prospect and say, what are the common characteristics with this customer? Even before you've had a conversation, and then once you have a conversation, what are you discovering and pulling out, and how do you just, continue to optimize and improve your ICP accordingly? So, um, they took much longer than I would have liked, and I would say ultimately this segmentation was one of the key things that kind of bit them on the softness of the new logo bookings because they just didn't have those insights.
Yeah. Where's that stage of maturity when the executive team at the portco actually knows how to do this stuff as opposed to you guys are coming in and, companies got good growth, but maybe in spite of themselves and that sort of thing, and you either need to bring in different people or you need to throw your value creation team. Like, well, where is that stage where you say this company at this point needs to have leadership team that knows how to do all this stuff?
I'd say when we enter, 15 million revenue, there's an expectation of repeatability, and that usually comes with an expectation of decent shared data models, shared goals between sales and marketing, everything's measurable. But the reality is they have some of it. They have enough of it to raise money, but they don't have enough of it that's truly enabling to glean insights and prioritize what these levers to scale the growth. And then it comes down honestly to business model. If it's a high volume and velocity and lower value deal kind of go to market model, those companies tend to be better with data out of necessity,
Yeah.
but they also tend to be more capital intensive. So one could argue that they're not learning and gleaning the right insights from their data and adapting fast enough based on what the data is telling them if they're burning tons of dough and they haven't figured out how to operate at break even or profitably, grow profitably.
So they've got a bunch of data, but haven't figured out how to actually leverage it properly.
Yeah, because they can tell a story about their funnel and how they forecast the business, should we consider that they're doing well on the data front, but they're burning 50% or more of of what they're generating in revenue? Like, no. That
Yeah.
you're not, something's wrong.
At what stage do you expect the CFO to be what I'll call a strategic CFO that kind of gets all this stuff and almost becomes the precipitator of getting the
Mhm.
go-to-market leaders all focused on this stuff, and to the example you just talked about, focused on efficiency and getting data so it will help us figure out how to get more efficient. Where do you see those kind of CFOs come in as opposed to the CFO that's maybe a, glorified controller?
Couple thoughts. One is when we enter, if there isn't a CFO who has kind of that FP&A muscle and is not just accounting and is more strategic, if that doesn't exist in the business, it needs to shortly following investment. So it's not uncommon that we're top grading, or maybe the CFO is strategic. It's a 25 million revenue business growing nicely. They have decent data, but they don't have an FP&A function. So it's either the CFO needs to be top graded, or you just have to put a really strong lieutenant in place because maybe the CFO knows what it looks like, but it's not really his or her background.
Yeah.
Um, so I think it's often that we're requiring, post investment that role is in place. And then it's a question of who's leading revenue. How much operational rigor has been instituted, and is enough attention been paid there? Because do you always need a CRO at 15 million revenue? No, if you've got, capable kind of VP levels, running across the key go to market functions. Um, if a CRO comes in, or you're top grading in the revenue organization, that person's just going to want to bring in a director or VP in charge of rev ops anyway. And maybe that person's in there, but they're more of a glorified Salesforce administrator than they are truly connected with the process and interlocked with sales, between sales, marketing, and customer success. It takes someone who's seasoned enough and can have enough influence and know how to sort of infiltrate and partner with those functions to be successful in the RevOps role.
Yeah. When you say CRO, are you implying necessarily that that person owns marketing, sales, and success? Or are you talking more about a more strategic head of sales?
Sometimes marketing reports in. It just depends on the profile of the CRO. Um, I'd say CRO, I'm thinking everything revenue. So it's sales, it's new logo, it's expansion, it's channel and partnerships, it's customer success, and it might also be delivery. If customer success and service delivery are really connected, like in an
Yeah.
enterprise sales model,
Yeah.
um, I would put that under the CRO as well.
Okay. Interesting. One of the fascinating, maybe frustrating phenomenon in the world we operate is how short the tenure of many revenue leaders is, whether it's marketing or sales, right? I mean, you see stats all the time, like 14 months to 18 months. I'd argue that a primary reason for that is when these new leaders come into the company, they don't actually have the tools they need to do the job well, the data. Like I'll put this at you. I think many time boards hire these people thinking they're going to make that happen.
Yeah.
But in my experience, that's really not their skill set. I mean, the more strategic ones appreciate the need for it, but they don't really know how to make all that happen, right? Because it's a systems and FP&A type
Yeah.
of skill set. And so, they sit there and sort of flounder for 6 months, and then, by that time, you guys are getting frustrated because they still can't answer anything in the board, meetings, and then, 6 to 9 months later, they're gone, and we just keep repeating this cycle. How do you react to that?
At the growth stage, if go to market leadership talent needs to be added or top graded, the right candidates coming in at 15 to 30 million in revenue company that's growing nicely, but still has a need for this person's skills, right? Eh, they're gonna expect strong measurement and metrics in a decent process. They may tweak something or add layers of sophistication on top of what's happening, but they're gonna expect a foundation, and they'll sniff that out. They wanna spend their time accelerating and scaling the engine, not building and fixing it. So, you gotta kinda look in the mirror and say, like, "What are we really solving for by thinking we need this hire? And is the business even ready for this type of executive to meet the expectations you have of them? Or there's some things we should expect of the current team or lower levels of the organization or finance, in the meantime."
So when you're interviewing prospective candidates for a leadership revenue leadership role, do you find that they kind of test the foundations to understand kind of what the infrastructure is they're gonna be playing with?
Yeah, the good ones do. And if
Okay.
they're not pushing on that and expecting to see numbers and understand and dig in that way, then it's a flag.
Yeah, interesting. So I was speaking once to a value creation person, go-to-market value creation person at a fund firm. They said, "Scott, first we get the people. We focus on getting the right people, and then we focus on the instrumentation."
100%.
I think it should be just the opposite. Because if that person it's just what we were saying. Why hire these people if they aren't gonna have the instrumentation there to let them be strategic and do their jobs, right? If they're gonna have to spend their first 6 months basically playing RevOps person,
Yeah.
it just seems like everybody's gonna get frustrated. Of course, I all of this is self-serving for me.
No, I think, I mean, honestly, it makes sense. There's just some color around it, I guess. With our value creation plans, post-investment, it's always people first, but there are also some things that you just have to eat the crust first and
Yeah.
do.
Yeah.
And a huge part of that is your process may not be perfect, but write it down, document it, implement it, practice under it, because then you'll figure out what you need to change. And if then you're hiring your CRO or top grading your VP of sales or whatever the role is that's coming in, they're going to at least have data and a foundation to work with to figure out what to optimize. So it's not uncommon, our value creation plans. We're not saying you need a CRO. Let's not do any of that process and data stuff until the CRO comes in. We're saying there's just basics here we need to get a couple quarters of repeatability on. And we can see from your Salesforce, we could see from your reporting, we could see from your performance what those tweaks might need to be. Or, God forbid, it's all being managed out of Excel. It's not in the CRM the way it should. The lack of hygiene. Like, can we please just step back and get to a common data model simply, and then we can tune it up
Yeah.
over time? We take execution risk. It's the primary form of risk that we take as investors. And it does start with people. Like the go-to-market team that knows the importance of alignment and interlock across the sales, marketing, and success. Without alignment, you can't accelerate. Core to alignment is, who's being sold, what is sold, how the value prop that is being sold is delivered. You need full life cycle data and metrics that tell management and the board if there's alignment and if we're ready for acceleration. So I think there are things that can be done. You don't have to boil the ocean to optimize foundationally in a value creation plan before you or while you or like running the searches and that you think you need. You don't put everything on hold. You got to run your business. You're wasting dough.
Yeah. Interesting. So you mentioned alignment, and I know you and I both are big believers in it. Why does it seem so hard to get, really good alignment between sales leaders and marketing leaders and success leaders? Or you can answer it a different way. What distinguishes between those companies where you do see it very good and where you don't?
Ugh. We could have, like, a happy hour on this, right? It almost requires cocktails. I think it's interesting. I see sales as a more mature function than marketing when our money comes into these companies. Sales has been invested in, there's a decent sized team. They have a playbook or something they're doing, but they've had to do it without what I'd consider proper, growth stage marketing partnership and support. So to have to then build marketing to catch up, it's going to take a while to get it all aligned. And I think we see that in spades. And they not only need, leads, but they need sales tools. And, they've been selling a certain way without all that support. And now they're getting it, but are they getting it, based on, are they going to get it in the way that meets the expectations of that sales leader because they've been doing it their way or they came into the organization with their own playbook and their own way? Part of the problem now too is there's just so many darn playbooks. Like, people have their things that they've done in different organizations, and frankly, a lot of it is bad habits. Like, what might have worked there isn't necessarily going to work here. Go to market models and customer profiles. There's so much variability in go to market. And folks think, like, my last two companies, all our deal sizes were $20,000 a year. So we're going to use these channels and our salespeople are going to look like this. And the quota to OT ratio is going to be 4 to 5x. And, but it depends on who the end customer is and who you're selling to. And it also depends on how much marketing leverage you're getting. And I promise you, the people who are like, "Oh, I've been selling 20K deals my entire career." The CAC in those companies were not exactly the same.
Yeah.
And neither were the sales cycles and neither were the end customers. So I think there's so much variability that the if this then that is usually flawed. And I think when sales is more mature than marketing, marketing has to catch up. And I think marketing uh, gets bogged down in the easier things like content and websites and event signage and event coordination. And it puts the hard, most critical things on the back burner, or they only do it in a small way when at the, you know, 10 to 20 million revenue range. Like, everything else should be taking a back seat
Yeah.
to revenue marketing.
Yeah, interesting. Yeah, when you said, people trying to apply the same playbook anywhere, uh, one example of that I see is how often companies still say what drives our revenue growth is the number of sales heads we're gonna have,
Yeah.
right? And I buy it. I buy that it does when sales prospecting is the primary way of generating pipeline. But in all these velocity models,
It
sales
can't.
is more of a
Yeah.
fulfillment mechanism than anything else,
Well, it should be. Yeah.
and yet everyone still drives everything off of sales heads. It's kinda funny.
We do a lot of bottoms up model building with companies that need it. And we'll do it during diligence is we ask hard questions about their forecast in, pre-term sheet and then after term sheet. And it just doesn't hang. We'll say, okay, listen, we'll build this with you. Let's just take an extra week or 2 weeks or whatever it is to do it. And it does enable us to really get under the covers and look at their systems and their reporting and maybe in a little more detail than we might have in standard diligence. I mean, we have the data, but having the time and focus to really pressure test what's going on and take what's true and incorporate it into your bottoms up model. More often than not, the company's bottoms up models are just salespeople. And with these velocity models or product led models, it can't be. And even if your marketing is immature, you could still make some
You gotta make
comfortable
assumptions.
assumptions
Yeah.
about spend and what that spend's going to get you and how things move through your funnel. We'll do that work with them. And then that will be the budget that we approve for,
Yeah.
for that year and for post investment. It starts to build the muscle for them to not think so narrowly about what a bottoms up model should be to forecast and manage the business.
Yeah. I'm sure in those conversations, because one of the powerful things about making those plans or those models at that level of granularity and kind of top down, from my perspective, is it then forces you to say, okay, are we instrumented in a way that we can actually measure in the
Yeah.
way we built the model,
Yeah.
right? And a lot of companies sort of build the model and then go off and start operating, and then you can't actually measure along the same axes, et cetera. So you've been on a lot of boards. You gave an example of sort of what it feels like when a company doesn't have their data right because you ask questions and they can't answer them in the board meeting. They say, we'll get back to you. And it may be 3, 4, 5, 6 weeks, right? Um, what does it look like when when you say, "Okay, this company is good at this stuff for their stage?"
This is very tactically, very basic. If the key go to market metrics that describe the motion and give you insights into the motion and what's going on are in an executive level dashboard or even the monthly financial flash that goes to, the investors and the board. If it's getting that level of attention, I beam. And then I have high hopes and certainly expectations for when you dig down deeper, what's beneath it. When the company starts using, this is what we use to manage the business. This is like they're truly managing the business against it. That's the beginning of great.
Okay.
I'd say further in a board meeting, I prefer appendix slides that say what happened in the last quarter, and I prefer to have a conversation about what's happening next in these board meetings, because if the reporting's good on a monthly basis, the appendix reporting is probably pretty good and you get an idea. But how you go forward, the conversation in the board meeting is, here's what we learned last quarter or in the last 2 quarters, which you'll see in the appendix, and this is what we're doing about it for the next 2 quarters, right? So, when there's an insightful, actionable narrative at the board level, like, we just feel so much more at ease that they know what's going on and they're managing their business accordingly and doing it based on data-driven insights, and even better that they're moving quickly to sort of optimize and address what they're learning. So learners and using data and showing the board that they're learners and in adapting and adjusting based on that, these are good signals too. I mean, this is qualitative, but it's got data behind it.
That makes sense. So let's take those signals during the point that you're evaluating an investment. So you guys are doing due diligence. Let's just say hypothetically you're looking at 2 companies with the exact same financial profile, but one management team comes off in the way you just described, clearly, learners leveraging a certain way of looking at data to run their business, et cetera. And another comes off as, I mean, they can get you the answers, but it's a struggle. And then they change their mind because they realize the data they were looking at wasn't good and stuff like that. Let's assume you would actually invest in both companies. Well, how does the valuation differ?
Like, are you saying
I
same
I'm trying
revenue
to
and
say all
EBITDA?
things equal,
Okay.
except one management team is far more mature in terms of using data in a way to move the company forward in a more sophisticated fashion. How do you value that?
So you have a company that knows how the number is gonna be made, and you have another company who's successful in spite of themselves.
Yeah, that's a easier way of saying it.
I mean, it could be a tick or two in valuation. I mean, and the team is probably going to not be equal. Like the quality of the team.
Right, it's sort of correlated probably.
Yeah. So the immaturity of the operation represents more execution risk, and therefore, that's gotta be built in to the price. So maybe you pay 7 or 8x on the business that's, knows how they're making their numbers, and you're paying 4 or 5x, assuming retention's
Y
strong and,
yeah,
all of these
yeah.
things, but, um, on the less mature, the less sophisticated team/operation. slash operation.
So that's almost double, and I know we're just sort of,
Yeah, you're right, but
hypothesizing here.
maybe that's an extra click on either end, but honestly, I don't think CEOs and founders really understand that their business is not worth as much if they don't get this stuff right. Like, the execution risk is too high. And yeah, PE firms and growth equity firms like us can drop in there and in 2 quarters improve process and make sure the systems are in place and bring in the right tech stack, partners like you. All of that can happen in a couple of quarters. So maybe we're willing to take the execution risk. Um, but it speaks to team, it speaks to operate the importance placed on operational rigor and how well they really know their business and their customer. And you can put process and instrumentation in place, but some of those other things are bigger, and team is a big part of it. Like, who are you backing?
Yeah.
And you can always replace and top grade, but in ELT, that mostly needs to be top graded post investment, shouldn't be getting, 6 plus X
Yeah.
ARR valuations.
That's interesting. And, I've always felt this way, right? That the better prepared, the bit more tightly managed these companies are, the more investors appreciate them from a value, and it shows in valuation. But it's still surprising to me how many businesses we see that the CEO is, yeah, I know we need to do that, but they're okay living with good enough,
Yeah,
and
and burning too much dough
burning too
and
much
yeah,
dough, and they just don't make the effort to fix that stuff before it's actually gonna impact them on valuation and stuff, and it's just
but then you
amazing
look
to me.
you look at their R&D line, and they're spending 30+% of revenue on product, but they won't invest in proper process and insights, data analytics for the rest of their business, right?
Right, and R&D spend is notoriously impossible to tie back to return. Interesting. So, you've been an operator, investor, board member. Any big changes you see in the world you live in as it relates to data?
I'd say companies have had to get religion over the last couple of years, few years, and durable, profitable growth is now the expectation. And particularly when you get to the stage where we invest. There's a lot of inputs to that. I mean, use of AI can make things more efficient, your R&D, lots of things internally, selling, marketing, um, uh, the value you deliver to your customers, to your product. There's a play there for every company in some way, whether it's internally or in the product. Um, but I don't think that's the primary driver. I think the macroeconomic environment over the last few years has been a driver. And I think finally the growth at all costs mentality that we knew from the coast and perpetuated, maybe even still a little bit in Silicon Valley, those days are gone. And especially when you get to the stage where we invest, I think venture, there's still some element of that. And there's still categories certainly in tech where we invest, where you're just gonna still see companies burning for some period until some level of scale is reached. Um, but we've always been focused on capital efficient growth at entry and at exit. and maybe companies burn for a year or two post-investment to accelerate things, but they get right back to profitability, uh, where they were when we started. We've added a lot more rigor to our own investment criteria and scorecard around this over the last couple of years, while there just were still so many companies that weren't managing to it. But now I think folks have gotten religion, and it's coming that way. So that's the expectation. You just can't not get your data right and get your systems right to ensure that you're placing the right bets
Yeah.
uh, in order to be a durably growing, business.
So back to my comment about R&D. Do you see, or are you guys part of, any push to, force that set of investments to be more measurable?
Yeah. I mean, it's part of a road mapping discipline and prioritization discipline for the roadmap. It's a big part of our value creation plans. Like, what are the buckets and how do you classify the areas of R&D that are, the priorities for a year or 2 year, whatever it is, roadmap. And if it's, quantifying new customer, growing customers, competing, saving companies money, like whatever the metric or value prop is, driving gross margin, ensuring professional services are more efficient so we can do less of it.
Yeah.
Um, all of those things are key criteria setting and classification of roadmap planning.
Last question, and thank you again for your time. Do you see more opportunity to drive efficiency gains in go-to-market or in product in most of the companies you guys invest in?
Probably go to market. Product has really low hanging fruit on like hosting and just like creating a little discipline and prioritization, like not allowing, a founder driven feature factory, right?
Mhm.
Like if you're spending over 25% of revenue in R&D, it at 15, 20 million in revenue, you've got tech debt. You've got a founder-driven tech, like a CTO founder mindset that's driving everything, and or you're just lacking the discipline and the prioritization that we'd expect of a growth stage company. So, can you bring that in line? There's so much lower hanging fruit to do that, but I think the ultimate optimization is in go to market to really get the scale factor going to drive efficiency at scale.
Kelly, thanks for your time. Enjoyed the conversation. I thought you provided some interesting insights. I think it's always super helpful for, operating leaders to really kind of understand how you guys from the board and investor perspective look at things, right? Because you have the benefit of seeing patterns across multiple companies, right? So thanks again.
Yeah, thanks for having me.
Make no mistake, good data matters for driving efficient growth and valuations. Follow me on LinkedIn, where I'm sharing insights from CFOs, investors, and strategic go-to-market execs. Thanks for listening to The Data Room.